Okay, so very good morning to you all. And today, the topic which I want to discuss first is the international arbitrage. But first of all, we need to know what arbitrage is. The arbitrage is a concept. If I have to define arbitrage in one sentence, I would say risk less profit or gain. The risk less profit or gain is when you are gaining something because you know something which others do not know. So you have an information edge. In other words, you have information asymmetry advantage, and the others who cannot follow this pursuit have the information asymmetry disadvantage. Okay, now I can explain this concept with this example below, which is very simple example. It's okay. Now imagine there are two shops, shop A and shop B in a street, and you know that you can buy a pencil for 15 cents from shop A. But if you go to shop B, you can buy it for 17 cents. And imagine that these shops not only sell the pencils, but they also buy it. So it's like if you have a pencil, you can sell at shop A and shop B. But if you want to buy a pencil, you can go to shop A or shop B and buy it. So it's very open. Now what you do, and imagine that shop A doesn't know that shop B sells for 17 cents. And shop B doesn't know that shop A is selling a pencil for 15 cents. It means that there's a lack of information for shop A and for shop B. But you are a clever person. You know it, that you can buy a pencil for 15 cents from shop A, and from shop B, the price of the pencil is 17 cents. What you do? You go and buy a pencil from shop A, and then you pay 15 cents, get a pencil, and then immediately you go to shop B. And then you say to the owner of shop B, hey, I have a pencil and I know that the price you pay is 17 cents. And they say, yes, that's fine. And you sell the pencil for 17 cents. So you buy the pencil for 15 cents from shop A and you sell it for 17 cents at shop B, and you make 2 cents per pencil. The gain. This is the gain. And this gain is a riskless gain. What is your risk? You didn't invest anything. Yeah. So this is a purely riskless gain. Before you bought the pencil from shop A, before you invested 15 cents, you knew already that you will definitely sell it for 17 cents because you know the market price is 17 cents. I mean, the market price for shop B. It means right from the very beginning, you are sure that you will get a gain of 2 cents per pencil. Now, this is called arbitrage gain, the riskless gain, basically. And this is because there is an information asymmetry in the market. If the market was symmetrically informed, then there would have been same price in the market, and you would have not been able to get this arbitrage gain. Okay. And what will be the outcome then? What do you think will be the outcome? Would you do it again if you buy one pencil for 15 cents and you sell for 17 cents and you make a gain of 2 cents? What would you do next time? Will this arbitrage gain will go forever? Will it go forever for the rest of your life? Or will it stop? Well, it will stop. It will stop. How? You are making so many round trips, and then maybe at some stage, the shop owner of A and shop owner of B would be a bit suspicious that why you're buying for every. First of all, you were buying one pencil, then you start buying more pencils, and you start visiting both shops many times a day. Okay, what will happen then? Well, remember that you are only buying pencils from shop A. It means that the demand for pencils in shop A will go up. And when the demand is increasing relative to the supply, the price goes up. Maybe at some stage, the shop A owner says, you know what, the pencil no longer cost 15 cents. Now it costs 16 cents. Why they would say it? Because you have been buying constantly from shop A. And as we know, the law of demand is that if the demand increases relative to the supply, then the prices go up. So at some stage, the owner of the shop A would raise the price, and then you have been constantly selling the pencils at shop B. It means that the supply is increasing because you have been supplying so fast. And once again, the law of supply says that if there is a more supply in comparison to demand, then the price will fall. So next time when you go to sell a pencil at shop B, the owner of the shop say, you know what, I'm sorry, we don't pay 17 cents for a pencil anymore. We pay you 16 cents because the price has gone down. Now this is a kind of heartbreak for you, isn't it? Because you were buying for 15 earlier, but now shop A has raised the price to 16. Shop B was giving you 17, but now they have lowered the price to 16. So what happens? You buy at 16, you sell at 16. So where is the arbitrage? The arbitrage gain is lost. And who did it? Eventually, the market mechanism of demand and supply would create this because you're buying at 15, selling at 17, it shows that the market is not in equilibrium. There is a disequilibrium in the market. But eventually, as you keep buying from shop A and selling at shop B, eventually the market would be in equilibrium because there would be pressure of demand in shop A, and there would be a pressure of excess supply in shop B. And eventually the B would lower the price and A would raise the price. And then the price which A and B both charge would be same. And thus this advantage which was associated with this information asymmetry is removed. Okay, so eventually this downward and upward pressures of the price would eliminate the arbitrage. So this is the basic idea of arbitrage. Now, take an example. The arbitrage could be locational arbitrage. Locational arbitrage means when the prices of something at two different places and shops, like in the previous example, no, is the price of the other shop or the other organization. In this example, I'm using these phrases bid and ask. And I hope you know that the bid means the buying price and ask means the selling price. And the ask price is always higher than the bid price. And remember that this buying and selling is from the point of view of the bank, not from the buyer, not from you, but from the shop, this currency shop or the bank. Let's take a bank in this case. If you go to bank C and you want to buy a New Zealand dollar, it means that the bank would sell it for 64 cents. But if you want to sell New Zealand dollar, it means the bank would buy it. The bank would pay you 63.5 cents. Well, there's no 63.5 cents, but let's put it this way, that if you are selling 10 New Zealand dollar, yeah, so then the bank would basically give you 6.35 American dollar. So to eliminate this effect of decimal. On the contrary, if you see Bank D, if you want to buy a New Zealand dollar from Bank D, it means the Bank D would sell it. It would charge 65 cents from you. But if you have a New Zealand dollar and you want to sell it, in other words, the bank would buy it from you, the bank would pay you 1 New Zealand dollar for 64.5 American cents. And here, the beauty is that the bid price of one bank is higher than the ask price of the other bank. Just compare. And if you see this kind of situation in the market, that one bid price, I mean, for the same commodity, for the same asset, the bid price is higher than the ask price. So in one location, the bid price is higher, and in the other location, the ask price is low. Eureka! You can make profit. What would you do? Well, you buy a New Zealand dollar from Bank C. In other words, Bank C would sell it to you, and they would charge ask price from you, and then you sell it for 0.645. You sell it me, the Bank D would buy it from you, and both banks are unaware what is happening because there is an information asymmetry. And for each 1 New Zealand dollar, you have gained how much? You have gained 0.005 American dollars. So if I eliminate these decimals, so if you are not buying or selling 1 New Zealand dollar, but you are doing it for, let's say 1,000 New Zealand dollars, then you would be getting this gain of 5 American dollars. Okay, and that's what's happening. This is a riskless profit. I shouldn't call it profit, because profit is when you are trading, you're buying and selling something. In a way you are, but I would rather call it a gain. Yeah, I would call it profit for the bank. Profit and loss is for the organization when they are, but here you are but speculative. You're only gaining this situation. Yeah, so it's more like speculative instinct than anything else. So I would not use the word profit. Maybe this profit I wrote here is a wrong word. I should call it gain. Okay, so when you are buying cheaper and selling expensive, and then it becomes this arbitrage gain. And once again, what will happen eventually? Well, this arbitrage would be lost at some stage because you keep buying from this bank. The Bank C might have shortage of New Zealand dollars, then they would raise the price, and you are selling to Bank D. So when you're selling them, maybe they have the excess of supply, so they would lower the price, and eventually it could be possible that your arbitrage gain is lost. And maybe not only you who is doing it, but the other people, your friends, your other mates, the other market competitors, they also know that, hey, what you're doing it, because they can watch what's happening in the market, and they also do it. And maybe the bank also realized that mistake, Bank C and D. Bank C manager calls Bank D or opposite, and they say, hey, what is happening? I think we are idiots. We don't know. Next time we should make sure that we keep the same prices. Okay, So eventually this arbitrage would be lost. But in financial markets, there is a possibility, even in the less developed financial market, this situation will happen very often. But even in the highly advanced countries, where the financial markets are highly integrated, there is fully electronic trading, okay, there is still a possibility of having the arbitrage. So don't think that this kind of phenomenon only exists in the less developed market. The arbitrage can happen even in the so-called advanced economies as well. But the only difference is that in the developed economies, this arbitrage does not stay longer. So if you are a speculator, you have to act very, very fast. In finance, time is money, basically. So if you see this opportunity and you know that you can strike the iron, do it fast. Because if you wait, then the others would do it, and then the bank C would raise the price and bank D would reduce the price, and eventually what happens? This situation is lost. So you have to act fast, very fast rather. So this is about the locational. So as you can see this example, that if you have 10,000 American dollars and you want to buy the New Zealand dollars, so what happens? You go to Bank C and you can convert your 10,000 New Zealand dollars, American dollars to 15,625. Because if you want to buy one New Zealand dollar, you don't have to give one American dollar. You only need to give 64 cents. And when you do this conversion, you find that now you have the New Zealand dollar 15,625. And then you take this 15,625 to Bank D, and they give you 645, and then eventually you get the total money you get is 10,078 American dollars, and plus you also get some cents. So you start your trip with $10,000 and you finish at 10,000 plus 78 American dollars. So this is the one gain. And if I put some more zeros and I make it 10,000, 100,000, 1 million, 10 million, then you can imagine that how much your gain would be. Okay, so speculators can gain a lot with this. Okay, so we move on to the next example. And this is also the example of triangular arbitrage. And I think last week, we had quite extensive discussion. In my previous video, which I shared with you, there was very deep, extensive discussion about the cross rate. Okay, so can we gain from the cross rates? I think we can. So for example, the actual rate of exchange of a pound to dollars is the bid price is this and the ask price is this. And the Malaysian ringgits is, for 1 Malaysian ringgits, the bid price is 20 cents and the ask price is, let's say, 20 cents. So I'm going to 4 decimal places, so it's difficult to explain how many cents. But dollar, 0.2020. And when I divide this by this, see the cursor movement? If I divide this with this, I get Malaysian ringgit this. And if I divide this number by this number, that's why we call them cross rate, I get the, I get Malaysian ringgit 8.2. In other words, this is the cross rate. And we discussed last week that the cross rate is never the actual rate. It is the equilibrium rate. This is the rate which should be if the markets are fully, efficient and competitive. But we saw that in reality, sorry, my apologies. This is the actual rate. So this is not calculated by this divided by this. So my apology. This is not calculated by dividing this with this. And this is not calculated by dividing this with this. Actually, these are the cross rates. And I have shown it with a formula that 1.60, this number is divided by this number. So this is the bid rate. And then 1.610 divided by this is this cross rate. So these are the cross rates. My apology for this. So I think I made a mistake. So the bid rate, the theory rate should be this. So in other words, if you are in Malaysia, and you want to sell $1 American, you should get 7.92 Malaysian ringgits. But actually, if you have an American dollar and you want to sell it, then in reality, the Malaysian ringgits you get are 8.1. In other words, in Malaysia, dollar is overvalued because you have to buy more than what you should. It means that in Malaysia, dollar is overvalued. It means that if you are having lots of dollars in Malaysia, you should sell them to get more money, because this is the money you should get. So for example, if you are having 100 American, or let's say if you have 10,000 American dollars, you should get 79,208 Malaysian ringgits. But actually, if you have 10,000 American dollars, you are getting 81,000. These pounds. Sorry, I should have said pound, not the. So if you have 10,000 pounds, there's so many currencies that I'm lost. If you have 10,000 pounds, you should get 79,208 Malaysian ringgits. But if you have 10,000 pounds, you are actually getting 81,000. It means that in Malaysia, pound is overvalued. Pound is overvalued against the local currency. It means that if you are in Malaysia and you have the pounds, then it's time to sell them. Because if you don't sell them now, then eventually the actual bid price and the theoretical bid price would become same. Okay. In the same way, if you want to buy 10,000 pounds, then the bank demands 82,000 Malaysian ringgits from you. But the bank demands 82,000 Malaysian ringgits from you. But theoretically, the bank should demand 80,500 ringgits from you. In theory, the bank should ask you to pay 80,500 Malaysian ringgits to buy 10,000 pounds. But bank is asking you to pay 82,000. It means that pound is selling expensive in Malaysia. In other words, you shouldn't buy pound. because this is the price which you should pay to get a pound. But this is the price you pay actually to get a pound. It means that pound is selling expensive. But if you have pound, sell them, but don't buy pounds in Malaysia. Do you get my point? So in Malaysia, if you have pounds, sell them. But in Malaysia, if you want to buy pounds, don't do it. And just the opposite. In Britain, if you have Malaysian ringgits, buy them. But if you have the Malaysian ringgits, don't sell them in UK. So it means that the market is not fully in equilibrium. The market would be perfectly in equilibrium if the bid and ask rate here is matching exactly this bid and ask cross rate. But here the bid rate is this. This is the rate should be. This is the rate it is. This is the ask rate should be, and this is the ask rate here. And that leaves room for speculation. And when this speculation happens, there is a chance that some traders would gain a lot of money. Some may lose also. You never know. So this was another example of international arbitrage. The international arbitrage could be in the form of location, and it can also be in the form of the triangular arbitrage. This is very interesting, this example, and I think in partially I discussed this example with you in our informal chat also. And this is called covered interest arbitrage. It means that if you have the arbitrage in the exchange rate fluctuation, this can be offset by the interest rate differentials. And if there are interest rate differentials, then it can be covered by the exchange rate differentials. But I explain it with the example. Explaining with the help of the example is much better than talking about the concept. But I think as we proceed, I will discuss with you the concepts as well. Assuming that you have 800,000 American dollars to invest. So it means, let's assume that you're living in the US and you have $800,000 which you are willing to invest. The spot rate is 1 GBP, the Great Britain pound, is equal to $1.60. So it means that this is a direct exchange rate if you are in the US. The 90-day forward rate is also the same. The forward rate is that if you are living in America, you have $800,000 to invest, and you ask the banker that, hey, how does the forecast of pound looks like? And the banker say that today the exchange rate is 1 pound is equal to 1.60 American dollar, and I can say you that even in 90 days time, the rate of exchange would be the same. So no change in the exchange rate. And then you ask your banker, hey, what is the interest rate you are giving me on my deposit? And the bank says, you know what, we pay you 2%. And then you ask, if I keep this money in America, if I keep this money in UK, how much interest rate I would get? And the bank says 4%. Now the bell rings in your head. The current exchange rate is this. The future exchange rate is also this. But the interest rate differential is 2%. You get 2% in America and you get 4% in the UK. And you have a smile on your face. I'll tell you why. You ask your banker, hey, Mr. Banker, I want to move my money to Britain. And you convert your 800,000 pounds to 500,000. Sorry, you convert your $800,000. Please correct me if I'm wrong, because I think I'm making a mistake when I am recognizing this. these currencies. So you have 800,000 in your bank account in America. And when you divide it by 1.60, you get 500,000 pounds in the UK. And then on this 500 pounds, you get 4% rate of interest in 90 days. And at the end of 90th day, your deposit is now, because if you calculate 4% rate of interest on 500,000, your deposit would be now 520,000 pounds. Because remember, you earn 4% rate of interest in 90 days. It means that your bank account, when you started your bank account today, you deposited 500,000 pounds, but after 90 days, when you want to withdraw this money, your deposit is worth 520,000 pounds. And now you want to bring this money back to America. And you knew that the forward rate which the bank manager has committed to you is 1.60. Very simple. So what you do, you multiply with 1.60 and you get 832,000. And how do you get it? Your number of pounds multiply by the forward rate. So this is the forward rate which you multiply. Not this rate, but this rate, the forward rate, 1.60. So you start your trip with 800,000 and you finish at 832,000. Now imagine if you had kept this money in America, in the US, you would have earned only 2%. It means that your deposit would have been only 816,000. But when you move your money to Britain, your deposit is worth 832,000. So you get 16,000 extra. And this 16,000 extra, which you get, is equal to 4% minus 2% multiplied by 800,000. So this is the covered interest arbitrage you get. So this is something which is like when you are playing with the interest rate differential and the exchange rate differential. So this is the arbitrage you get. Now what will happen in this case? Eventually, there is if you are doing it, the others can also start doing it. So everybody, there's a more demand for pounds in America. So in other words, because everybody want to move the money, converting their dollars to pounds. So there's more demand for pounds. So as a result, the exchange rate of pound will go up. And everybody is withdrawing money from the American banks and everybody is depositing money in the British bank. So as a result, American banks would find a shortage of money and they would raise the interest to attract people to keep money in the American banks. And on the contrary, the British banks would be flooded by money from America because everybody is depositing money in the British banks and the banks would be full of money. And then they would lower the interest rate to discourage people from bringing money from America to UK. So when this exchange rate becomes not 1.60 but like 1.70, I don't know how much, but we will see how much it should be. And on the other hand, the interest rate in US will go up, the interest rate in the UK will go down, and this value would be higher than 1.60. Then eventually, this arbitrage would be lost. Okay, if you want me to show you how much it should be, if you want me to show how much it should be, then Okay, so let's calculate this covered interest arbitrage example. Let's basically calculate that what should be the exchange rate so that this arbitrage doesn't exist. So, but let's do it first. So you have, let's say you have amount, and the amount which you have in the US is 800,000, if I'm not wrong, and this was in American dollars. And the spot rate of a pound the spot rate is 1 pound is equal to, why can't I have this? Okay. So let me insert here. Well, I can use the letters instead. It's a bit complicated because I have so many bars, so I don't want to mess up. So 1 GBP and USD. In the spot market, spot means now, spot rate is 1 USD is equal to 1.60. And if you check with the bank manager in the US that, hey, what is the forward rate? And this forward rate is, by the way, 90-day forward rate. So it means if you want to buy a pound in 90 days or sell, how much is the rate? And I'm ignoring bid and ask because that will make the example complicated. And the bank manager say it's still same. And then you find out that the interest rate here in the USA, which is your domestic country in this example, is 2%. And whereas the interest rate in the UK is 4%. So what you do, step one is that you convert USD to GBP. And how much you get? Well, you get 8, are they 100,000 or 80,000? I think I put the wrong number. Maybe I need to change a little bit. So this was, I'm sorry, it's a formula. So it was 800, 8,000, 80,000. One more zero, I'm sorry. Yeah, this is now 800,000. So your GBP are equal to this divided by the spot rate. The spot rate means the price now. Step 2. You transfer funds from US to UK. In other words, now you move it. So that is, well, step 3. From US bank, I should say US bank to UK bank. Step 3. At the end of 90 days, you get interest on your deposit. So how much interest you get on your deposit? Well, the bank would give you this money times 1 plus the rate of interest is 4%. So it means that the value of your deposit at the end of 90 days, you get interest. I should say not interest. I should say at the end of 90 days, the value of your deposit, because obviously when you deposit the money, you not only get the interest, but you also get your principal amount back as well. For sure, you get it. And then step 4. Step 4, you transfer money back to the US. Okay, so this time you have 520,000 GBP. And I must remind you that this is the GBP, so that because even though you know that it's in Britain, so that it will be pounds, but still to avoid any confusion. So now you multiply this with the forward rate, which is this. So now you have dollars worth 832,000. Okay. If you keep your money to remain in the US bank only, just in case, you don't move it. I'm writing in capital so that you can see the difference. This is a kind of, in that case, your money would have been multiplied by 1 plus 2%, 816. So the interest arbitrage, covered arbitrage, you can say. The covered arbitrage is basically the difference between these, and this, by the way, is in the US dollars, so we shouldn't confuse it. USD is equal to this minus this. Okay. Or you can also calculate it by, or you can also calculate you can also calculate covered arbitrage. Sorry. which is, I'm sorry, I think there's something wrong with my, which is equal to multiply by 4% minus 2%. 4% is the rate of interest in the I4 is your amount in your domestic country, which is 800,000 US dollars. And 4% is the interest rate in the high interest country, which is the foreign country, which is UK. And 2% is the rate of interest in the domestic country, which is US. There we go. So these both are the formulas of so this is how you can calculate the covered interest arbitrage. One thing which I want to discuss with you, what should be the forward rate of 1 GBP to USD so that there is no such arbitrage. No such arbitrage exists. It means, what should I do that this 16,000, this or this 16,000 becomes zero? What should I do? Well, in that case, this amount should also be 816. How do I get this 832? Well, I get this 832 by multiplying H13, which is this, with I7, which is, it's so difficult to see because I have so many things to do. So basically, I'm trying to make an equation that what should I multiply 520,000, that the value is 816. So if I want to find this exchange rate, then I would say 1 GBP, and this is forward rate, by the way. This is the forward rate. So this should be equal to, this should be equal to this multiplied by this. It means that, and this is in the USD. Yeah. It means that even if the UK is giving you 2% more interest, but if the forward rate is not 1.6, but if the GBP forward rate was USD 1.57, then this 16,000 which you get extra would not have been, because then you would be getting almost 816,000. And this we get from here, by the way. So in other words, if your American, the money which you get in the US bank at the end of 90 days, divide by the money you get from the American bank, the money you get from the British bank is this, the money you get from the American bank is this. So if you deposit these two amounts, then you would be getting a new figure, 1.57. So if this was not 1.6, if this was not 1.6 but 1.57, then all the extra interest which you earn in the UK would be lost when you convert this money from Britain to America, that is from pound to dollars. Then you would get in the American dollar approximately, because it's some decimals also. So well, more or less it will be 816. So if I basically multiply 520 with this exchange rate, well, you get exactly 816 here. In other words, if there is a forward rate 1.57, okay, then this all arbitrage would be lost. But if this exchange rate one is more than this, 1.58, 1.59, 1.60, even more, then this arbitrage will go up. And if this rate is below 1.57, 1.56, 1.55, 1.54, 1.53, then not only this amount, this arbitrage would be lost, but in fact, you will be having a loss. So below 1.57 is an arbitrage loss. I will not call it arbitrage loss, it's a loss. Above 1.57, there's an arbitrage gain. So we know the limit, we know the threshold, that if the threshold limit is 1.57, anything above this is an arbitrage gain, and anything below this is a loss. It means that this is basically your, how to say it, this is the equilibrium rate, equilibrium, spellings, equilibrium exchange rate, which ensures that there is no arbitrage gain. Any exchange rate more than 1.57 will give arbitrage gain to investors, moving their funds from low interest rate giving US banks to the high interest rate giving UK banks. And any exchange rate of 1 GBP below the USD 1.57 will cause a loss to the investors. Thus, the rate of exchange 1 USD, 1 GBP, sorry, equals to, let's call it 1.57 because it's for many decimal places, so let's call it 1.57. So this thus the exchange rate of exchange 1 GBP is equal to USD 1.57 is a cutoff point with no arbitrage gain, with neither arbitrage gain nor any loss to the US investor. Oh, such a big point. My apologies if you find any spelling error, but I think you get my idea. That's more important. And this file I'm saving on my computer, and I would be sending it to you after I complete it. I save it. Well, I should save it in your folder so that I know that. Global Financial Management, I think it should be GFM, then I can. Sorry, I just saving my right folder. GFM docs. Covered interest arbitrage. So let's call it no covered interest arbitrage, no gain. Or maybe covered example 2. I had actually another example, but I thought that is a bit complicated. So I thought maybe I should stick with this example only. Okay, so this file, you will get it today along with the video. Please let me know if you have any queries, if you have any questions about it. And so now I repeat this whole story, which I said in the beginning. You are living in the US. That's a very simplistic example, but let's go with this. And you are a company or an individual, and you have 800,000 American dollars as a saving, as a surplus. And you ask the banker, how much interest you give me? And he says 2%. Okay. Any high interest giving country? And they say, okay, UK is giving you 4%, right? What is the spot rate? Well, the spot rate is 1 GBP is equal to 1.60 USD. Let's make it to 2 points because otherwise it doesn't look good. The numbers to 2 decimal points, yeah. Okay, and then you say, what is the forward rate? This time they don't say 1.60, because if they say 1.60, you would be having arbitrage gain, and you would do the same thing which I explained in the example. But this time they say, you know what? The 90-day forward rate is 1.57. And now when you do these calculations in your head or in your computer, you find that if you move your money to the UK, because it's a high interest giving country, you will get at the end of the period 816,000 US dollars. And what if you keep your money in the US? Well, you still get $816,000. So what's the point? So you will not be taking this arbitrage. There's no arbitrage basically. But if the banker tells you that the forward rate is 1.60, then you will go for it. And then you will have this arbitrage gain. This is the same thing. So this is the idea behind it. Recording here. I want to continue the same example, and I want to show you that how the interest rate parity theory comes in action. We haven't discussed it actually yet, this theory, but in a way, we can discuss it in the same example, and that will make our life easier and simpler. In the beginning of this example, when we started, why do investor wants to move his funds from USA to UK? Because UK is giving you 4% rate of interest, whereas in the US, you get only 2%. So the interest rate differential is 2%. It means that UK is 2% more interest giving country. And according to interest rate parity theory, it should not matter if you move your money to the high interest rate giving country or you keep your money in the same interest, the lower interest rate situation. Because if you do it, if you move your money to the high interest rate giving country, then the high interest rate giving country's currency would depreciate against your domestic currency, which is the US dollar. And you can see that the US dollar 1 GBP was for 1.60 US dollar. But now the pound has become cheaper. Why pound has depreciated or lower value or cheaper? Because UK is giving you high interest. And the countries which give you high interest rate, often their exchange rate or the value of their currency goes down. And approximately, I can say that this difference, 4% minus 2%, let's call it interest rate differential, is approximately same as the fall in the value of the pound. And how do I found it? I took the forward value of pound minus the spot value of pound, which was 1.60, and divide by 1.60. And I find that if the exchange rate of a pound to the dollar is 1.56, then this would eliminate any possible arbitrage gain happening to the investors. So I can even write a comment here. If I can edit it, is it possible to edit? I think so. No, delete. But no, I don't want to delete it. I just want to edit it here. This idea cutoff exchange rate, where there is no arbitrage gain, is the basis of interest rate parity theory, which is called actually IRP. Sorry, this is want, I can spread it so that you can see it more clearly. And this, so here I can give a comment. High interest excess of 2% rate of interest given by the UK bank is neutralized by the 2% decrease in the value of GBP against the USD is neutralized by approximately, I can say by approximately 2%. Decrease in the value of GBP. Yeah. So this is the basis of the interest rate parity theory. That you may gain in high interest rate, but you can lose in exchange rate. And this is why you can see the sign is negative. So this is how it works. So now we don't need to study the interest rate parity theory as such, because we have done it. Okay, so that's basically everything for today. So I explained to you the arbitrage in general, which was covered, which was also, which in the beginning we studied was locational arbitrage, and then there's a cross arbitrage. And then we studied two vital concepts, that was a covered interest arbitrage and the interest rate parity theory. So lots of things. You see the beauty. We have studied theory with the help of the numbers, so not other way around. Normally people study theory and then they try to find the examples. But what we did was, we did the reverse engineering. We created an example, and with the same example, we studied covered interest rate arbitrage, and we also studied interest rate parity theory. So we studied two theories with the same numbers. That's why I like finance, because you have theories, but you can test them with numbers immediately. You don't have to argue because it's so obvious. Okay, so I was thinking to spend more time, but there's no need now because we have done the same thing, the new theory with the same example. And I never thought about it. But anyways, I would be sharing the recording once I get it. And then along with this recording, I would send you this spreadsheet. And I think this is a very big, very important thing we have done today. And I must thank you for this, because your questions made me think like this. Otherwise, I would have never considered this aspect. So that's it for today. Thank you very much. And you will find the Excel and the video soon. And have a nice day.
Thank you. Have a nice weekend.
Have a nice day.
Before you go, you can ask me.
Yeah, I just have a question.
Yeah, please.
You said that we have to do something for next